In this week's episode, we are going to discuss what 5 executives from 5 major Wall Street investment firms have said is going to be the potential outlook for 2025 and what you can do to protect yourself from that. Let's roll.
Welcome to the Safe Money Retirement Show with your host, certified financial fiduciary, Tim Wood. Tim is a retirement and income planning expert, best-selling author of Safe Money Retirement, Your Game Plan for Success, member of the exclusive Ed Slott Master Elite IRA Advisor Group, and founder of SafeMoneyRetirement.com. Tim uses an education-first approach with clients nationwide to ensure they understand their choices in planning their own safe money retirement. Tim focuses on wealth management, retirement income, tax and long-term care planning, and asset protection and growth strategies. And now, from the Safe Money Retirement Studio in Johnson City, Tennessee, your host, Tim Wood.
Welcome to the Safe Money Retirement Show. I'm Tim Wood, a certified financial fiduciary and asset and retirement protection specialist. 5 leading Wall Street analysts recently were interviewed by CNN, and all of them said that they foresee a possible bear market coming in 2025. I'm actually going to read some of it right off of the CNN story right now. First, if you don't already have your own copy of my book, Safe Money Retirement, Your Game Plan for Success, give us a call and get your own copy. It's completely free, no obligation. We will send it to you because we want people to really understand what their options really are in retirement as far as guaranteed income plans or growth with no loss plans or taking care of long-term care or taking care of legacy or all of these things. So give us a call or just log on to our website anytime, safemoneyretirement.com. Get your free copy from there or give us a call, 833-413-SAFE. All right, let's go ahead and jump into this article because there's a lot I want to get through. First, like I said, 5 of the top leading analysts. We're talking about analysts from Moody's, UBS, JP Morgan, Invesco, and Yardeni Research. All of them say there's a good possibility that there could be a bear market this year in 2025. Basically, the chief economist at Moody's, here's a quote from him. His name is Mark Zandi. He said, "I'm very concerned because the stock market is pricing in nothing but blue skies and sunshine forever. The market is very richly valued, bordering on frothy." That's what he called it, frothy, which means overvalued. Zandi also told CNN he hasn't been this worried about the market since the dot-com bubble of the 1990s and fears a drop of around 20% sometime this year. So my question to you is, are you ready for that? And we're going to talk about that here in a minute. But are you ready for that if that comes? The next one, David Kelly, he's the chief global strategist at JP Morgan Asset Management. He actually agreed. Quote right from him, "I'm worried about asset bubbles," he told CNN. "A lot of castles in the sky have been built on the foundations of this very stable economy. You could have a big correction at some point in the things that are not tethered to reality. There are a lot of very frothy markets out there that could take a shellacking. Investors must think carefully about how much risk they are wanting to take." And that was actually a warning that he said. So I'll ask you that real quick. How much risk are you willing to take? Now, if you're listening to this and you're in your 20s or 30s, you can take a lot of risk because historically the market has shown that it's got overall growth. But if you're in your 50s, 60s, 70s, maybe even 80s, how much can you risk? You've got to determine how much do you have to have in order to live the retirement that you need to live and make sure that you've got that protected, that you don't have to worry about that. UBS also recently sent out a warning to its clients, arguing that many of the conditions of a market bubble are already present. Now, this is Andrew Garthwaite. I might be mispronouncing his last name. I apologize. UBS's global equity strategist in December wrote, "The problem with a bubble thesis is that when the bubble bursts, investors tend to lose 80% of their money. And according to UBS, key bubble indicators include declining corporate profits, heavy participation by retail investors, and a significant time gap of at least 25 years since the last major bubble, which there has been. A bubble happens when there is a narrative of it's different this time around, normally associated with technology or market dominance, and we have both. So there's somebody else that says that there's a potential downturn coming this year. So again, my question for you is, are you prepared for that? What are you going to do to counter that? Are you ready? Is your retirement portfolio ready for that? And on top of that, this is actually something else that I wanted to, but it piggybacks right on this. According to recent data, defaults on U.S. credit card loans have surged to their highest levels since the 2008 financial crisis. In the first 9 months of 2024, lenders wrote off $46 billion with a B in seriously delinquent credit card debt, a staggering 50% increase compared to the same time last year. Now, this is a sign that many consumers, especially those with lower incomes, are struggling under the weight of rising costs and inflation. It's basically the lenders write this off because they know that there's a really good chance that they're not ever going to get this. But what does this mean? If the trend continues, it could lead to a slowdown in the economy, potentially easing inflation, and possibly on the brighter side, actually lowering mortgage rates and inflation. But all of that put together, all of these top market economists, what's going on with all of the bubble, what's going on with the credit cards, what's going on, we can see with our own eyes. My point is, you need to make sure you are ready for whatever's going to happen. If the market goes up, that's fantastic. But what if all 5 of these experts are right? What if there is a drop of 20% or even more in this coming year? Are you ready for that? Is your retirement ready for that? If you've got millions and millions of dollars, then you probably aren't worried. If you've only got $300,000 saved, well, if you were to lose half of that, that would really put a hurting on your retirement. You need to make sure the money that you absolutely must have for your retirement, you need to protect it, especially the closer you get to retirement. Y'all heard me say this many times. One of the numbers that is just a general number that we use in the industry is based on whatever your age is, about that percentage of your money should be protected in some sort of a protected guaranteed account. So if you are 68 years old, about 68%-ish of your money should be protected. 75, about 75% of your money should be protected. What do I mean by protected? I mean something that is in a plan that will not go down if the market crashes. Whether that's in an income plan or whether that's in a growth plan, there's multiple different types of plans. But we can put you into a plan that guarantees that no matter what happens in the market, you aren't going to lose a penny. That's what you need to focus on, and that's what you need to make sure when you are approaching retirement, or even more so in retirement, to make sure that your nest egg is going to be there when you need it. Since I have to take a break, now would be a great time to call for your complimentary copy of my book, Safe Money Retirement, Your Game Plan for Success. My number is 833-413-SAFE. That's 833-413-7233. Isn't it time to stop exposing your retirement to market risk? You're listening to the Safe Money Retirement Show with Tim Wood.
Did you know that your Social Security could be much higher depending on which option you choose for claiming your benefit? Social Security income is more complex than some think. When should you take it? Should you only take your spouse's benefit while you continue to work? Deciding how to receive your Social Security benefits can make your head spin. Don't decide about your retirement without the facts. Call us now and ask for your complimentary Social Security guide at 833-413-SAFE. That's 833-413-7233. Your Social Security is too important to leave to chance. Call us now at 833-413-SAFE. That's 833-413-7233.
Welcome back. I'm Tim Wood, your host of the Safe Money Retirement Show. I'm a capital preservation and strategic income planning specialist. In today's case file, we're going to look at a very unique situation, and this was with Henry and Sally. Henry and Sally came in to see me. They already had a lot of things taken care of in their retirement. Henry had a substantial amount saved. So they were basically self-funding their retirement, and with the amount that he had, it's pretty safe. They already had guaranteed income, and they had plenty to cover their expenses because they'd paid everything off, so their expenses actually were quite low. They already had life insurance to cover things. They already had growth plans. They basically were all set. The one thing they didn't have was something to take care of long-term care if that ever popped its ugly head up. And as many of y'all have heard me say, just in 2022, a congressional committee actually came back and showed that over 70%, that's 70, over 70% of people over 65 are going to need long-term care at some point. So he came in and we were looking at different options. Now, getting a long-term care, a regular, old-fashioned long-term care policy, you would want to do that in your 30s, 40s, maybe early 50s. They were already in their early 70s. So getting a traditional long-term care policy wasn't a real smart move for them because it would have been extremely cost prohibitive, and the benefits, and the rates would have just kept going up. It wouldn't have been a wise move. So what we actually looked at and did for them was an asset-based long-term care plan. And what it actually was a life insurance plan that was a single premium. They just paid a chunk and it was paid for, so there were no more payments due ever. A single premium life insurance plan that had a long-term care benefit built into it. Now, I'm not going to say the exact amount that they used, but I'm going to give you an example. This particular plan, if you had put $300,000 into it, well, if you never use it, then congratulations, someone's going to get a $300,000 death benefit when you pass. But if you need to use it for long-term care, that $300,000 doubles to $600,000. So you now have $600,000 in benefits that you can use specifically for long-term care. That's what we did for them. They left so happy and so relieved because, as many of you have probably seen from your friends and family members, long-term care is a major thing that can really suck resources because the average right now is between $8,000 to $10,000 per month for long-term care. Now, I don't care how much money you've got, $8,000 to $10,000 per month adds up real fast. So that's what we did for them. Well, I'm about out of time, and I would like to thank you for listening to the Safe Money Retirement Show. If you're serious about your financial future, give me a call, and together we'll get your retirement savings on the fast track to accumulate while reducing exposure to market loss. Thanks for listening, and until next time at the same time, I'm Tim Wood reminding you to stay safe so you can step into a secure future.
You've been listening to the Safe Money Retirement Show with your host, Tim Wood. Find out how to contractually guarantee that your income in retirement is guaranteed lifetime income and not if-come. Avoid any future market losses, plan for the potential of long-term care, and make wise tax planning choices so you can have the retirement that you deserve. Call us now for your free copy of Tim's best-selling book, Safe Money Retirement, Your Game Plan for Success. Call 833-413-SAFE. That's 833-413-7233. Or log on to our site at safemoneyretirement.com for more information or to request your free book. Thanks for joining us. We'll see you online at safemoneyretirement.com. The preceding information does not represent tax, legal, or investment advice. Obviously, by contacting us now, you are only taking the first step toward protecting your retirement. No information presented today should be acted upon without meeting with a qualified licensed insurance professional. It's important that you read all insurance contract disclosures carefully before making a purchase decision. Interest and other guarantees in annuity contracts are subject to the claims-paying ability of the insurance carrier that issued the contract. The tax consequences of annuity income should be considered with the help of a licensed tax professional. Rates and returns mentioned on this program may vary based on state availability and are subject to change without notice.